Before you start watching, this is a giveaway alert. We are giving away Amazon vouchers worth 500 rupees to one lucky subscriber for this video and the videos which are going to be released in the coming weeks. All you need to do is like, subscribe, and share this video anywhere on social media tagging the Builders Club. The handles are at the screen below as well as in the description. You can do it on Twitter, LinkedIn, Instagram, Facebook, anywhere you want to. And the more number of videos you share, the more chances you have to win. And now, back to the video.
Shareholder agreement, the term sheet, all these things are very critical elements that a founder doesn't pay attention to. And you can't give excuses. I just want to stress on this. You can't say I'm first time, I didn't realize. No, it doesn't work that way. The kind of effort that is being put by the investor, they put in their own due diligence, they put in their own teams, they make sure that there are platforms that they are creating. So whether it's an angel syndicate or a VC, they are here to support the founders. It doesn't matter whether they're on 10 investments or 100 investments. The things don't change. Time memorial also, investor wants returns. Ultimately, they make their money when there's a proper exit. So when an exit happens, that's when they make their money. And you must understand that that's what they will always concentrate and focus on. Kind of thing. Supposing they raise 100 rupees, at least 2 to 3 rupees is actually going to be used to pay salaries, to run the operations of the fund. Okay, and it will be minimum 3 years. If you only try to do small cities, small this, you'll only grow so much, and getting the bigger investments, bigger exits are difficult. So they will look at global scale, they will look at the sector, they will definitely study what are the policies and regulations. If X investor is only D2C and you're some SaaS or fintech founder and you're trying to chase them, they will also think, why is this guy, why these people are writing to us, because we don't really look at this domain. They, like supposing if you don't understand a certain sector and then you try to invest in it just because you like the founder or something, it will be a disaster, right? Because founders may be great, but you're not understood the technology, you're not understood how big the market is, and you've done a blind, if luck plays a role, then you're okay. But what if you're not done proper due diligence? Understand this, it's not just that the market is very huge, so what? There'll be hundreds of people chasing the same thing. So what is your USP? What is the deep moat that you have created? How strong is your technology? How great is your team with complementary, supplementary skills? This is what a VC will look for, right? And pray kind of thing is not really advisable. You should reach out to the right kind of investors, because think of the time that you're wasting or using up. And you also have to run business, right? The founder has to run the business, he has to grow, he or she has to hire.
Today we have a dear friend of ours, Vijetha Shastry sir. Vijetha Shastry sir is one of the very few people that I know who has spent close to 3 decades in the startup ecosystem. He started his journey in the services industry, and then he kind of got into the startup ecosystem. He has been associated with almost all the big names in terms of the startup community that you know of. So be it NASSCOM, be it TIE, be it Head Start, be it BHIVE, he has basically helped in the overall community building and the outreach programs for all of that. So welcome, Vijetha sir, first of all, to the Builders Club.
Thank you so much, Sohail. It's absolutely my privilege, and also it's a delight for me to be interacting with all of you wonderful people. Thank you for giving me this opportunity as well.
Vijetha sir, we have been trying to get you on for some time now, because I think you are one of those who has kind of seen the overall journey, the startup ecosystem grow in a sense.
Absolutely.
And when there was nothing, when the buzzword of when the buzz of the whole funding and everything was not there, even then entrepreneurs were being born. And from there, now that the ecosystem has kind of, if I may say so, reached a kind of a stage where we can say that the startup founders are also a little bit mature and they understand what they're getting into, and the investors also understand how exactly to deal with stuff.
Yes.
So Vijetha sir, we can probably kick this off
Sure.
with a little bit of your own journey. Probably start off with your early journey. Where did you work in the initial bit? And how did you get introduced to the startup ecosystem? And then your journey through, and now that you are a part of Dexter Capital as well. So you can probably help us run through that journey.
Definitely, sir. I'll keep it as light and easy to for everyone. So currently, I'm with Dexter Capital and Dexter Angels. So Dexter Capital, we're an investment bank. The focus is on Series A plus. How do we get them to in front of the right VCs and family offices so that we can help them to raise a Series A plus money, as I said. And we also have a division around mergers and acquisitions. Dexter Angels is where we do the early stage investments as a syndicate, and we have done about 25 investments. So Dexter Capital has been around for 9 years. Before that, I was also with TIE Bangalore as the executive director. I was part of the NASSCOM Center of Excellence for IoT, taking care of all the activities around open innovation and co-creation. And also, Sohail, I've been an active volunteer with Head Start for the last almost 7 years now, 2015. And because of that, you name the place, right? Kerala Startup Mission, Startup Odisha, working with all the accelerators and incubators, helping them to grow, working with the Karnataka startup sales. So all this I would feel has given me a lot of perspectives. I've had a lot of help on the way. Let me be very clear that it is never a standalone journey. We have people who are supporting us, helping us. The corporates are there, the enterprise are there, the governments itself that I've worked with. Fantastic folks, genuinely wanting to do something. And very honestly, startups can say that they're in a very good position right now because this kind of support, this kind of value that will be given to them is incredible, and very few ecosystems do it. That's why India is so active. That's why Bangalore is so active. But I've been traveling non-stop, so much. I've been to Jaipur, Kolkata, Bombay, Delhi, and Kerala also recently. I'm going to Chennai next week. What matters is build the bridges, Sohail, right? I mean, some things like what you guys are doing, right? All the events. You're sitting in Bombay, but you've done about 3, 4 events and more in Bangalore. You're trying to give a lot of value back. You're bringing in people who could give perspectives. So when I started my career, with hotels and retail industries, I was with Taj Hotels, I was with Metro Cash and Carry, Urban Brands, Reliance Retail. I've learned a lot from my leaders, from mentors, and you can learn from everyone, my friend. Everyone is so good. Everyone is so helpful. And I think this is a paid forward culture. I want to emphasize on that, Sohel. It's important to help. It's important to give. It's also important to bring in as many people together, like create bridges. Like you are sitting where you are sitting, but you're building, a builders club, right? That's what you're doing. You're trying to bring the like-minded people together and help startups. I think that's awesome. So I will take a pause here so that we can have a real-time conversation as well. And
So, sir, today's topic is around the whole idea of how an investor thinks, because a majority of the founders, and since I have also faced this, is because a lot of people, when they start off, they really don't understand the whole way an investor or a VC firm or somebody who basically invests in any company work. What is their philosophy? What is their thought process? What are their North Star metrics? Because of which there is a lot of disparity between how a founder approaches an investor and assumes that this is how things work. And there is nobody who actually clears the air from the investor ecosystem as well, because majority of the time they themselves are so busy that they don't waste time on prospects which they don't think that they can either add value in some form, or probably they don't fit the portfolio. So Vijetha sir, I basically want to understand from you, one, the perspective, or what is the basic North Star metric that any investor chases, and how exactly do they go about it? This, and then probably we can also delve a little bit into how this mindset has evolved with time, because you have the know-how of how things used to work 10 years back also. Because I remember in 2012, 2013, when the new startup ecosystem had just started, and the Flipkarts and the Ola started getting funded. At that point of time, the kind of checks that used to be written was purely on an idea stage. But now those things are not possible, right? So I just want to understand what is the perspective, what is the mindset of an investor, and what are their North Star metrics, and how that has evolved with time.
yeah, definitely. So we'll just break it up into simple, easy stuff so that it's a very clearly understood thought process. See, remember that for an investor, few years back there were less companies, the sectors also were less, and the fact that the markets themselves were maturing. But now if you see, because of the 5G telecom and the way that COVID has, of course, brought in the reduced and or maybe increased the digital divide depending on the perspective. So because of that, the things don't change. Time memorial also, investor wants returns. Ultimately, they make their money when there's a proper exit. So when an exit happens, that's when they make their money. And you must understand that that's what they will always concentrate and focus on. Of course, an investor would invest in sectors where they have a deeper understanding, where they know that they can also add value to the founder. So let's break this up into the when you say investor, right? It could be even your family and friends or investing. It could be, or if you have a strong alum network and they all come together, and then you have angel networks, not just Dexter Angels, but so many others are there. We are collaborating and working with so many other angel networks. Why? Because we believe that we can all collectively put in a lot of support, and we can collectively make sure that we can help these founders to grow. Now, what is growth as such, Sohail? It's not just about money or customer. Whatever happens, we are giving them the guidance that they need. Okay. And some investors would say, of course, the larger VCs, they actually sit on the board. They'll actually be working with the startup founder and the founding teams and the leadership teams very, very closely to make sure that the MIS is perfect, the corporate governance and due diligence is done. Think about this. The kind of effort that is being put by the investor, they put in their own due diligence, they put in their own teams, they make sure that there are platforms that they're creating. So whether it's an angel syndicate or a VC, they are here to support the founders. It doesn't matter whether they're on 10 investments or 100 investments. They will put in their teams to back you up, because ultimately all this will have to lead to exits. When follow-on rounds happen, exits happen, is when they make money. Now, because there is so much of competition, say when you say edtech or you say fintech or SaaS, or there are so many sectors within that. At the same time, there are hundreds of companies trying to fight for the same customer pie, wallet share. There's hundreds of companies trying to grab the investors' attention. So sometimes yes, we slip up, people don't respond back on time, etc., etc. So all these kind of challenges happen, right? But believe me, and I can say this with tremendous confidence and the insight that they genuinely care. They want to get back. No one wants to miss out. They know that they are there because there are great founders or their great startups are there, and they can invest in them. What are the things that they will look out for is the founding team. How big is the sector? Can this team actually address it? They will do a lot of due diligence on the founders, right? Who are they? What are they? I mean, what kind of reputation do they have? And in alum networks, right? They will talk to people that you don't even know that they would be talking to. But there's a lot of background checks that happens. They will understand whether the industry is really ready to grow, and that's why they will get their exit. Only when lots of investments come in to sectors which are hot, because they know that this is going to grow. But at the same time, there are failures. At the same time, there are unfortunate closures happen, etc., etc. So they try to be careful and get in as much information as they can about the sector, about the capability. Can the founders take stress? Can the founders really not just sit and say wherever they're sitting, but can they expand globally? And this is something very critical, because if you only try to do a small city, small this, you only grow so much, and then getting a bigger investments, bigger exits are difficult. So they will look at global scale. They will look at the sector. They will definitely study what are the policies and regulations. I mean, the controversies that are happening, challenges that are happening, especially in fintech and blockchain and whatever the whole Web3 and NFTs or crypto thing, whatever. Right? They'll be very careful about will something go wrong where because for no fault of anyone else, regulations change, policies change, can it collapse? Can an entire sector face trouble? We know what happened during COVID, right? So the co-working, co-living, etc., all these places, but they're making a comeback now. So the investors will watch the future trends. Okay, now it's down, but next few years there can be tremendous growth. There are terminologies that we hear about called patient capital, right? But just be careful that capital can only be few years, because they have a thesis. Investors who have taken money from pension funds or governments or larger entities or sovereign governments, etc., they have to also return that money back in a few years. Okay, so these are some of the things. And it's important to understand this, because if you don't, as a founder, you must think from the point of view of the investor. You must do your research work. Many of the investors have actually come as entrepreneurs. if you realize that in many of the VC companies or family office, etc., there are founders who are taking decisions and are getting involved with other founders before a check is written, because they've been through that and they know what has happened. And I want to again stress corporate governance, due diligence, the checks that are and balances that are happening around diversity, inclusion, environmental goals, etc., very serious, and they're looked into as a very clear mandate by a lot of VCs and family offices. Pay attention to these things, and then then as a founder, you can gel well with the various analysts or with the principals, etc. So keep these perspectives in mind, and I would love to take a small break here and get back to Sohel if there are any other thought processes or
So,
inputs.
from what I understand, Vijetha sir, ki number one, I think the North Star metric for them, for any investor who puts in money, is the exit, right? So they basically try and understand what is my possibility of getting an exit here. So irrespective of whether a company is doing good or bad, or whether a founder is really good, or if the company is really, you know, let's say there is a company which is bootstrapped and which does a lot of revenue, they don't need, or probably, but they are in an industry which probably will not get a follow-on investment. So usually the investors would try and stay away from it. Correct me if I'm wrong. I'm just trying to understand the mindset of an investor. So from what I understand is exits are the major thing that any investor kind of chases.
Ultimately, they are answerable, right? They are answerable to that.
Yeah.
Without making money, how will they support a
Exactly.
large team?
No,
How
no,
will they be
because,
able to raise more funds? You remember, a VC or a family office also keeps raising money. They go back to the people who have given them money, or they, if you see, new fund announcement, fund 2, fund 3. So they are also being judged. They're also being,
exactly.
their track record is being looked into.
No, so this is exactly the point which I'm trying to stress at, is because a lot of people don't understand, and they sometimes have a very hard, they have sometimes hard feelings towards people who have said no to them, even when they think that their idea is really brilliant, but the investor probably has said no. So what I'm trying to stress at here is that because they have a very different metric that they are chasing. It's not that they don't want to see you successful. It's just that probably you're not fitting into their portfolio at that point in time. So, Vijetha sir, I basically want to understand a little bit more about the money which a VC firm technically raises as well. So, from what I understand, so I want to understand. Technically, a VC firm is also like a startup only, right? So every startup, like, they have to raise money. A VC firm has to raise money, as in that is how a VC firm operates, right? So they basically accumulate a lot of funds from family offices, XYZ, and different sources, and then they pool in that money, and then they start investing it in different places. Very similar to the way a trader works. If I'm right with that analogy, that they basically diversify that money in such a manner that there is a certain amount of return that they can expect, right? So what are the numbers, right? So if I want to quantify this, that, let's say, number one, what are the sources from which an investor usually gets money? Number two, what are the kind of returns that they are expected to make and give back? Because if you're looking at a 20%, 30% return, so that to anyone can make from putting it in the stock market only, right? Why would anybody want to invest via a VC firm? What is the mindset there? And what are the expectations from a VC firm once they basically pick up the money from the family offices?
Sure. So all this is, shared very openly by the VCs. For example, they'll have a management fee kind of thing. Supposing they raise 100 rupees, at least 2 to 3 rupees is actually going to be used to pay salaries, to run the operations of the fund. Okay. And it'll be minimum 3 years, because you can't really do 3 years, 5 years. It all depends whether that how long that money can be kept in the startup and follow on rounds, put in tranches, etc. And then, of course, within the VC also, there will be subject matter experts. So some might be looking, they might look only at SaaS, they may look only at fintech. So you see a lot of specialization also happening. Okay, so every VC is different. Okay, and then also remember that what does it ultimately mean? They have to give some returns back to the people who have given them the money, and from that money that they made as profits, they keep as a carry. So that carry is then used to expand the teams, reinvest, and also to make sure that none of the startups go down just because of certain aspects that happen. Like how COVID came in, or some or some things that happen that which is not in the control of everyone.
Mm.
So the VCs also are, as I said very clearly, they are responsible. They, like, supposing if you don't understand a certain sector and then you try to invest in it just because you like the founder or something, it'll be a disaster, right? Because founders may be great, and but you're not understood the technology, you're not understood how big the market is, and you've done a blind. Okay, if luck plays a role, then you're okay. But what if you're not done proper due diligence? I want to again stress on that. Okay, in any business, due diligence is a very critical. Understanding the market and the sector is very different, and it's very important to know what could be the forces that could be on your side or could be against you, right? So if you try to build something only for, say, the elite of India, which is a very very small minuscule market and there's so much of competition, you know, we have to scale up. Or if you build something for Bharat, but then if there's no pay, if the customers or the consumers or the users don't have the ability to pay, you can never scale up. And so these are some of the things that the VCs will look for. They will talk to pension funds, they talk to government. So I'll just give you a quick inside the thought processes. Remember, and you can, just research this also. Temasek is there from Singapore. They're a government, partly funded by the government of Singapore. They, of course, will look at Singapore and they'll also put in a certain amount of money into other startups, correct? And then there are some funds which are having global presence. You have people like Sequoia or SoftBank, or you have Goldman Sachs and their funds, etc. So it could be very, or some VCs say, okay, we only invest in Indian startups, right? Because we're in India, we talk about them. Then there are some people like Saha Fund, which is run by Ankita, and then you have NQPA, etc. They will focus only on women, where the women founders are playing a very, very key role. It is being led by a woman founder. They believe that they should back these kind of funds. Then there will be people like Fireside Ventures, which looks at D2C, like Kanwaljit and his team, excellent people. They have backed some of the finest D2C startups when it was not even such a big name and it was not even coined, like direct to customer. No one really understood what that, but they believe they walked the talk. They supported the founders, and they've seen a lot of success stories. Then if you come, there is Bloom, which does early. So it's all public information. How much money they put in, what is their portfolio, what are the kind of sectors that they put in, etc., etc. Now, of course, people are talking about new age technologies and metaverse, and we don't really know what that is going on. That's high risk. And we also know what has happened with some of these new age companies on blockchain, NFTs, and crypto. Things are very, very tough, very, very bad. If they got out at the right time, they're superstars. But if they're stuck, they're really badly stuck. And, we really don't know how much money will they be able to get out. Also, remember that where does the original source of money comes? Industrial houses, HNIs,
Right.
pension funds, governments. So when stock markets are doing well, they have had exits from the stock market. They might have sold some companies. They have corpuses, so they keep some of it aside for themselves, and some of it they put into some, say, 4 or 5 funds. They'll put it, right. If you see, like, there are general partners and lead partners, etc., of the funds who actually go out and talk and raise money for the VC from the ecosystem or from the community or from wherever. It could be from Abu Dhabi, it could be from Qatar, it could be from Saudi Arabia, it could be from Singapore, it could be from USA, it could be from India itself, or Japan or Korea. So there are many funds, and I mean, in India itself, there are more than 250, 300 VCs, if not more, who are active at different stages, different sectors, and it's all public domain that is available for the founder. So why I'm saying this is that spray and pray kind of thing is not really advisable. You should reach out to the right kind of investors, because think of the time that you're wasting or using up. And you also have to run business, right? The founder has to run the business, he has to grow, he or she has to hire. So be very, very careful in terms of the time and energy and money that you put in. If you just reach out to the wrong investors, and you're not going anywhere. So be careful. And there is no such thing as not having enough knowledge or not having enough time. You must do your market research, must talk to the right people. You must understand the portfolio. See, can I also give you one more thing? Like, if you know that this company, though they're into fintech, they've already invested in a certain sector of fintech in multiple companies. You are just one more, while they would like to maybe focus on the startups that they've already put in money. So these kind of things make a big difference to founders. And remember that these are critical small things, but make a big difference. So I'll take a pause here, and I hope I could answer most of the elements of your question.
So I guess one of the takeaways is basically the due diligence bit. So one is the market, that how big is the market. So whenever a new wave comes in, a lot of investors usually try to get in, is because one is this whole FOMO factor, which kind of rides in the investor ecosystem. I just want to understand, why is there this FOMO? So is this because they want to get the right company at the right time at the lowest valuation possible, or why exactly is this FOMO factor there in the, so for if one person puts in money in a company, then you see hundreds others also putting in the same company, and nobody, if their competitor is there, they usually get silent. Why does that happen?
We should realize that these investors are the most smartest people in the room. They are extremely well educated. They talk to each other. They discuss things, etc., etc. Okay, and also it is about scale. When they see an opportunity and they see that this is the kind of founder and stuff, and look, it's a rarity, right? It's not the best. You have to really dig to get the diamonds out, and even with your best of research, you will make a mistake. Okay, so at Dexter Capital, of course, we are investment bankers. We take startups who are raising the Series A and above, 4 million, 5 million, whatever. We take them out into the market, correct? And we talk to VCs, we talk to family offices, we talk to people who would be willing to put in some money. And you'll never, I mean, no way will you see in any of the startups that only one person or two persons or something has put in money. They all de-risk themselves, and they believe that collectively they will work together. They will help these start founders to grow. They will help these founders to get best hiring. They will help them with PR, etc., etc., etc. So these are all very critical elements. So I don't want to get into these headlines of FOMO and terminologies like that. So they do their own due diligence, right? They're also answerable. They have their lawyers, they have their chartered accountants, they have their board, they have their advisors. So we assume that there will be a lot of digging deep into the founders, etc., etc. And they're taking bets. Everything, there is risk. Things can go wrong. Who thought about what COVID could come, and the travel industry, the COVID. Yeah. So it's nothing is certain in life. But you take calculated risks, and then you back the founders, so to make sure that the founders can grow. So ultimately, by doing that, you will also make sure that your money, whichever you put in as an investment at whatever stage, will also be taken care of. And it's also a trust factor, right? I mean, we have alum networks. We have people like, we ourselves have a Dexter Angels is a network of angels. So they believe that, yes, you are very good at this, I'm very good at this, X is very good at that. We can provide some, tremendous value add to the startup and the founders. Someone would be very good in technology, someone would be very good in opening doors. The third person could be very good in, just PR, just shouting out for these founders and taking them to the next level, etc. So everyone brings in value, and a lot of headlines are there, but we should just learn to ignore that. And look, investments is also about the customer money, profits, family, friends, take working capital, take loans and pay it back. So there's so many ways that you can prove as a founder that you're doing the right thing. And then that's the belief system that will be created. When investors also see that, the governance is very good, the thought processes, the dignity of the founders, and the way they're approaching and tackling the situation, they would love to back these kind of founders. So make yourself irresistible, I mean, like make the investors want to back you up. That's the key.
I think one of the things that I want to touch upon here, I have one more question. After that, we'll open it up for the audience, and I will continue asking questions post one or two questions. One, I want to understand, what is the structure of a VC firm? I mean, the org structure, like, what is the org structure usually like? I've seen that the teams are usually very small, but there is a huge chunk of work that each one of these people do. So what's the org structure like of a VC firm?
So it's all public information, whether you take Matrix or you take Sequoia or you take any of these big guys, or Waterbridge or Bloom or whoever it is. So they'll have the GPs and LPs. They're the ones who actually run the fund, right? There would be like Avnish Bajaj is the MD of Matrix, because they're big. Then you have Nexus, and then you have all these guys, and then you have India. I'm just talking India now. I'll not go too much into the how foreign funds operate. So the main people will be the GPs, LPs, the top guys, and then you have a lot of like people who are, say, partners or principals, right? And next, if you go below that, you have senior analysts and analysts, right? So now, many of these analysts would have come from the banking industry, or they come from consulting firms, and they would be very, very, very good in doing very deep dive into sectors, into startups, and understanding whether the market is big enough, etc., etc. Okay. And look, there are no right answers or wrong answers here. I mean, I could keep talking for 2 hours and I'm not even able to scratch the surface. But what matters here is that you don't necessarily have to approach the GP or LP directly, right? You can approach a partner or a principal, etc., etc. Because ultimately, whatever comes in will be taken to the analysts, right? They will go through it, they'll dig deep, there'll be investor calls, they'll ask for MIS, they will ask for a lot of information about how you're tackling the problem, what is your moat, what is your USP. And that is where it is very clear that there are elements about a VC and the way they do it. And look, this is all whatever I'm telling you is public information. Their theses, their portfolios, their people, everything is out there. So dig deep as founders. It is hard work, but there is no shortcuts. So that way, what will happen is that you will get to know a lot of information. And then I think very critical, and this is something that people keep missing out is as founders, find out some of the people who are there in a VC's portfolio and talk to the founders. Okay, so why I'm giving you not just about a structure of a VC or how they raise money or what is the org structure or whatever it is. It goes very deep, right? There will be interns, there will be people who are working on research reports, and people who will be analyzing the research reports also. Like all the top 5, 6 consulting companies take out a lot of reports. Zinnov takes out reports, NASSCOM takes out reports, CII takes out report where they talk about, this industry, this is what policies are. The government themselves, if you go to Startup India also, they have so many affiliated funds, VCs over there, right? So these are why I'm talking about all these things is like one is a structure, but the thesis, the portfolio, like what kind of exits, if any, that they've had, what are they doing, their programs, their open houses. As founders, take time to just kind of understand this aspect very deeply because that helps you. And then when you're talking to the investor, when you've done your research work, those conversations go much, super fast. Rather than you asking them all kind of questions, they asking a lot of questions. Think about this. They want a great founding team. They want to know, make sure that the addressable markets, etc., and your capability to address it. Understand this. It's not just that the market is very huge. So what? There'll be hundreds of people chasing the same thing. So what is your USP? What is the deep mode that you have created? How strong is your technology? How great is your team with complementary, supplementary skills? This is what a VC would look for, right? And then if you understand who the partners are, if you understand the principals, and if you understand who's the senior analyst, and you know whether they have done a lot of work. Many of them are public, right? They talk about the kind of research work they've done. Shirate does it also. They recently published so many reports, whether it's on EV and so many. There are drone reports, EV industry reports, etc. Go through it because why do they do that? Is because they want to also talk to the finest of the founders. So right, they also need to make money, right? Ultimately, it's not about just that I've raised a lot of money, I'm a big shot VC. Wealth creation is a critical angle of it, right? So we at Dexter also keep talking about that, right? Like how exactly do you invest in new age companies? How do you do the research work? How do you approach the right people? How do you make the matchmaking? So these are things, public information. So I'm going to take a pause to understand more about what you want to talk about and what the audience wants to talk about.
So I think research is a major angle for all VC firms. No, they basically dig deep and go into the industry and try and understand where is the need gap, which is going to grow the most, and then they basically try and figure out that okay, so these are the companies which are basically operating in this ecosystem. So let's find the best of the lot and then basically make a move. So usually is it inbound, outbound? Because I'm sure that there is a lot of inbound, there's a lot of trash. Whoever I've spoken to, whoever is in the VC ecosystem, they say that they have mind-boggling number of pitch decks which come in every day, and siphoning through it itself is a big headache for them. And 99% of the pitch decks are trash. So what's the usual modality like? Is there a chance that a good company usually slips by and you really can't do anything about it, and you later on know that hey, there's something which is in my anti portfolio, I said no to them and later on became a success?
Yeah. So again, there's no right or wrong answer, and it's almost impossible to look at everything in the So that's what founders should also do is create a one pager and also create a more elaborate one, and then say that okay, if you're interested, I can send you more information because that's what really works, right? Get the one pager with all the critical information for them to take a decision whether they want to have a longer call. So we also get a lot of inbound, and we take those calls. We fix up time and do a deep dive. We ask them for some information, etc., which will help us to make the decision better. So you should always, for the founders, I would say that think from the investor point of view, a VC or a family office or early stage, depending on what kind of funding you're looking for and what is the right information that they want. And that's why you do the research work. And if you do a spray and supposing like okay, I said if X investor is only D2C, and you're some SaaS or fintech founder and you're trying to chase them, they will also think, yeah, why is this guy, why these people are, writing to us, because we don't really look at this domain. So
Mm.
think about it from those angles also. And if there's someone who does only seed or early stage investments, and you are asking them for, you're not, you just have an idea, and but you're asking them for $10 million, would they really reply back to you? Maybe not. So what really matters here, once again, fundamental research work. Just take, and it doesn't take too much of effort, right? Just do it properly, do it correctly, talk to a few more founders. And I encourage that, it's such a warm and giving ecosystem. People
Mm.
are going to, all the various events that happen, the mixers that happen, the conferences, etc., etc. Because this is where you can really get a pulse of what is happening in industry. You can meet the right folks. You can have, very simple but elegant and very focused conversations with the right folks. So that investment of time, energy, money into networking, into understanding what exactly a VC is looking for, etc., will help the founder, and vice versa also, right? Even all the investors also are out there, right? They send their teams out to meet people, go for demo days, and go for the speed networking events that keep happening all over the country. So this is hard
Mm.
work. This is a lot of effort. You can still make mistakes. You may still miss out. Maybe the founder couldn't articulate properly, though they're a great bunch of folks, and they couldn't really explain the technology, or it's a newfangled technology which the investor couldn't understand. Many things could happen, and like again, like there's plenty of opportunity. There's plenty of things that can be done, but make it easy for each other. That's what I say as a community person,
Mm.
and magic will happen.
So I had a specific question. So we are in a stage where we are looking to add a very useful resource, because I'm a first-time founder, as you're mentioning, right? Networking is a key asset. Researching again becomes a key aspect of the overall journey to move to a next level when you are either trying to raise fund. So in this scenario, our approach was, I spoke to a couple of founders, that why don't you have an expert, or basically as an advisor, who is also basically who is coming at an intersection of investment and subject matter expertise. So since we are into mobility ecosystem, an investor who might have invested into mobility platform, an angel investor, get him on board as an investor, basically as an advisor who will also invest, but also get you those important introductions, or will at least the person will point you which direction to look for. So how do you find that particular advisor? I'm yet to basically, I'm not able to find that particular specific, because we are into mobility platform and that also SaaS. So still in India, as of now, to be honest, mobility ecosystem is not that evolved as compared to fintech or some other solutions. But yeah, how do you find that advisor? Where do you look? What are the key pointers? How do you connect? And yeah, you can let me know this.
Ishan, I will explain this to everyone, not just to you. There are a few things here. Number one is be very, very cautious in terms of the legal angle.
Yes.
Yeah. So do you have a lawyer? Do you have someone who can draft these kind of agreements for you? Is very critical. Number one.
Yes.
Number yeah. So number one. Number two, but be careful. If because if you make a mistake there, then you're in deep trouble.
Sure.
Okay. Number two. Number two is that look, there are a lot of industry bodies like TIE or NASSCOM, whatever, which you can you can become a member of, etc., etc. So you widen your horizon.
Hmm.
Like, you should not just say that okay, I spoke to one, two people and I think they were good, and I know, be careful, because again you should the more knowledge, and this is also your way of building industry relevance, industry connections, etc., etc. Number three is that when you are you paying them money, can you afford to pay them money? What are they giving you this advice and offers for? Right?
Hmm.
What is the contract that you're going to have with them? What is the give and take, etc., etc., right?
Hmm.
Now, if you're giving them too much of advisory shares or something, your next round of funding will be bad, because
Okay.
the investor will just say, look, you're giving away too much,
Hmm.
right? So, and you're not very clear on what value you're getting, and why can't you do the sales yourself?
Hmm.
Why can't you go out and you make a list of 15, 20 people that you should be talking to as customers, and you should be talking to them, right? You should be, as a founder, you must be able to open doors and do the first sales. Okay. So yes, you're taking a shortcut, but can you afford that shortcut in terms of money? And how do you evaluate the right person? What is your evaluation metrics? How do you know that this person will actually help you and will actually be able to not just give you connections, but open the door for you, sit with you, tweak your product, etc. So there are so many parameters. So have you drawn a checklist of that?
Not exactly. So I
Yeah,
just
do
have
it. First do that.
so I just
Yeah.
have two specific
Kishan,
requirements. So
very specifically, I'm giving a requirement now, Kishan.
okay.
I'm giving a requirement unless and until you have made that checklist, until and unless you have made your you have gone out and met more and more industry folks, gone for mixers in that section, gone for a conference. You are going to walk into a landmine of your own making.
Got it. So just a small follow-up question to that.
Yeah.
So I'll work on that particular checklist. So as per as our team internal requirement and the stage we are in, so we already have a good pipeline of 20 plus corporates ready to use our solution. We specifically at this stage require an advisor who will jump as an angel investor, but also help us with the raising.
Put it out on LinkedIn, no? Make a nice note and put it out on LinkedIn. Let people revert back to you.
Got it. And what is the compensation that you decide? So we have a
that's between you. That's between you and that person. Right?
Okay. Any market standards that we have to follow, or is it like
there are no market standards? It's your ability to negotiate and convince.
Okay.
But be clear on what outcomes you want, Kishan, because this is where the danger zone is, no?
Yes.
They will see. They will also negotiate, right? They know that it is your need. They will convince you to pay them a lot or give you a lot of, or to give stake in the company and whatever it is, right? But if it's not linked to milestones and actual outcomes, you will be the loser, Kishan. So that's why, do you have a lawyer? Have you understood what is NDAs? Have you understood what is contracts? Have you understood what is, what kind of services you have to draw for an advisor? And you say, okay, you're supposed to give me specifically these things. And unless you do all that, it's very dangerous. Okay. So unless you have your detailed checklist, Kishan, and not just for you, Kishan, buddy, it's for everyone. I've seen too many disasters happen where you're not ready, you're not prepared. And then advisors say, boss, you took me as advisor. You were not ready. You didn't ask me the right questions. You were not prepared. You didn't have a checklist, but you still had to pay me. You still had to give me my share. Whatever, if it's a shares or whatever it is, right? And then it can get you into deep trouble later on when you go for institutional investing. They'll say like, boss, you wasted money. You're given shares to someone. You messed up your cap table. How are you going to handle all that, Kishan?
Got it. Makes sense.
Think about this. I just want you to be very. I read your question also on the chat, but think about what I'm trying to explain to you. That you have to do your own. Yeah. Be more careful. Do your own due diligence first.
Makes sense.
It's not ready-made. This will not just come that okay, EV industry. Okay, let me go to say Amit Gupta of Yulu, or I'll go to. Because it doesn't work that way, right? They're all running their own company.
True.
Yeah. Cool. Thanks.
Makes sense. Thank you for the point.
Thanks for the advisor part. It was really a kind of opening our third eye through it. Sir, basically this is Ashwin, and we are an electric vehicle startup. Initially we worked on electric car. Due to some cash intensive process, we cannot go further ahead. So we tried to apply some government grants, but we were shortlisted for the final rounds. Some were neglected since it's a cash intensive, so they neglected. Some said that some reasons. So now we are working on this electric vehicle startup for past 6 months. So we are getting a good traction in it, in the sense of pre-orders. Like we have got more than 20 plus pre-orders unofficially. So we have not yet registered the company, but why we are not registered is like we are trying to get some bank loans from our locality. So what the point is, when we getting bank loan, they are asking us to create the current account in their bank only. So we didn't register the company so far. Registering the company is not a big deal for us. So it just takes 1.5 weeks or 2 weeks for the private limited entity. So that is the one question. And the second part is, so in what metrics investors evaluate to back up us? Like we are electric cycle startup, so we have got 20 plus pre-orders, but still we have more milestones ahead. So what will be your suggestions to follow up so that we could get good metrics in Series A like that?
Have you got any money yet from family and friends?
Yes, sir. Fully we are bootstrapping only, sir. We are not got any investors.
So don't think about Series A funding and all that right now, right? Your pre-product, your pre-MVP and all that kind of thing. You have to convince your network.
Yeah, I'm getting it.
And taking working capital and all that is also difficult, because if you're taking a loan, you have to service that loan.
Yes, sir. Yes, sir. So that's why.
So where is your revenue coming from? If there's no revenue, and then you take a loan, and then whatever the collaterals are like given up. So be careful on that. Get money from your networks, first. and
Okay,
get
sir.
some products out there. Or, see, look, if you can convince your customers, you said you have 20 pre-orders. Will they, like,
Yes.
people, will they be willing to pay you a small advance which you can use to build a prototype, etc., etc.? These are the ways to go about it. But register the company. I mean, you need a proper
Yes,
company.
sir.
Otherwise, you cannot get anything, right? Nothing can be done.
Yes, sir. Yes, sir.
Yeah. So registering the
Yes, sir.
company
Sure,
is the
sir.
first question. Second question would be also, like, like if you're hiring, like, what are the kind of people you're going to hire? What is the differentiation between you and, say, if you're doing electric bike? I'm just saying, right? There are about
Yeah,
15, 20
electric
very,
cycle, sir.
very,
Yes, sir.
yeah, yeah. There are 15, 20 brands right now which are, well funded and doing extremely well. So what's going to be the difference between you and them? And why would the customer cannot trust you? See, you may have pre-booking, but they're not paid any money, right?
Yeah, I'm getting it, sir.
Yeah. So then that has no value unless there's some intent is there, some proof of booking is there, and you're a proper entity, etc., etc. And if they give you some money, how long are you telling them? Will it take you 2 months, 3 months, 6 months to give them back that? No? So I mean, I'm just saying. So don't get into these pre-orders without money, right? Because
Yeah,
that's
yeah,
not really
exactly,
proof.
sir.
Yeah,
Exactly.
that's not proof, Ashwin. Okay. Raise money
Yeah,
from family and friends. Yeah, that's the way it should be.
yeah, getting it, sir.
Cool. Thanks a lot, Ashwin.
Hi Sohail, hi Vijetha.
Hi.
So,
Well,
my question is very pretty simple. I understand like the cost constraints are there, but if I'm developing something which requires particular amount of capital, right? And even if you deploy it, and maybe it's what do you call that? Maybe it's MVP stage also requires a pretty good amount of capital. What I'm building right now, right? So my understanding is maybe I'm building something around Web3, but I just had an understanding ki, can I make it work in Web2 also? So why should I leap into a technology if that is not required? Right? Because when I studied and researched, I found that many of the startups which are in Web3, they could be easily done in Web2 and would have been doing good rather than doing it in Web3. So my confusion was there. But if I do in Web3, I'm more profitable. If I see the numbers, if I do in Web2, I can still work that out. But maybe at some places my profitability is not that much, and because the technology is providing me those factors. So is it more like selling two boats, or is it a good thing कि yeah, I'm heading towards understanding कि अगर ठीक है एक fail हो रहा है, then also I have something to take care of.
See, ultimately, it's about the users,
Yeah.
and it's about the people that you want to back you up, right? Which includes your team or your investors or customers, right? Basically, whoever is going to pay you. And look, there's a lot of hype around Web3, but if it's Web2 guys are not sleeping, correct? They're also rich. They've got deep pockets. They've got fantastic people to build products, and it won't take them much effort to get into the Web3 thing and tokenizations or payment gateways or whatever it is, right? I mean, let's be careful. I don't want to use it, think about crypto and all that kind of thing, because really, India, if you're doing for India, you're going to get into a regulatory block of wood and wall, and that's going to make sure that you can't grow forward. So what matters is your customer. Yeah, if you're going to be able to build a product that you're willing to pay for, and you're going to use that to enhance technology, because I think 5G is going to be, formally inaugurated by Geo, I think next week in about 15, 20 cities, etc., etc. So you're going to have a lot of new technologies, new support coming in, right?
Correct.
But then if you really want to do something, is do it, get some customers, get some users, get some traction, get some proof of concepts, and then you will also know what you need to do. So it's not about having Web3 for the sake of having Web3. No? Okay, so
Yeah.
what's so great about Web3? Why
Correct.
should I,
Correct.
as a user, I mean, does it help me in any way, or just you're in love with the technology? It's about sales, it's about traction, it's about convincing the right people, your right target segments. Focus on that, Chandrakant. That's
Yeah.
more.
So there's
That's a
nothing
think
wrong,
about it.
right? Yeah. So
I
I
don't
have
know.
same
So be
similar
careful. Be careful.
understanding.
You're asking for an opinion when I don't even
Yeah.
know your product.
Completely. I'm just taking
There's
an
no
opinion.
opinion. I have no opinions, buddy. Huh?
Okay. Sure. Got it. Thank you so much. I'll have a
Build
follow-up.
and make money, get customers to pay for your product. Then you're okay.
Got it. Thank you so much.
Oh,
Hello,
hi.
hello.
and yes, I am Alain. I am the acting founder of Alinoim Incorporated, and yes, we have as working prototype or products TVs and computers that we produce, and we enhance some key properties of these electronic devices. And we also have other products that we have already currently been working on or in the background, though it's true it's not market test yet for those other products, but the ones that are market test so far is the TV and the computer. So now my question is, uh, there is this event I'm so attend, and first I don't know the key stakeholders that will be present there, and because the initiators of these events have not given an open details of the number of persons or who is going to attend the event and how the person is going to attend the event. And so I find it hard to know how I'm going to target the networking. I find it hard to know who exactly I'm going to network with and how I'm going to do that. Nextly, these products we plan not just to target a few sets of customers or clients, but we plan to go on a very large scale by 2028. But for our current budget or estimated budget for this phase, we are estimating $10 million, which we believe will be able to help us attain our objective for this particular phase. And I would also like to know, how am I going to, how do we practically value the share acquisition associated with these amounts?
So Sohail, I am a bit confused, but I'll try to.
So I'll rephrase that. So number one, what Elaine is asking is if he's going to an event in which the agenda is not clear and he doesn't know what kind of people are attending, how should he approach the networking? Because he doesn't know who to target, right? Number two, he's basically asking about. Ellen, you were asking about the $10 million of funding that you're looking for.
Yes, 10 million. How much of the shares should we associate with the $10 million?
How much equity? How much equity should that have?
Should we associate?
Yeah. So these are the two questions.
Yeah, sure. So one is that let's imagine that you're going for an event. Okay. If it's physical or hybrid or it's whatever, it really depends on whether the organizers, and this is important, right? Always talk to the organizers. Know who the organizers are, because they are the right people who can, if you have a good rapport and you build good relationship with them, they will be the ones who will actually help you out. Okay. People forget this. They only look at the speakers and they're trying to chase the speakers, and obviously it's almost impossible to crack that. Then listen, there is LinkedIn. You know that these are the speakers, you know that these are the people, you should reach out to them. Okay. So I would advise first be good to the organizing team, because they are the right people who will be able to help you. For example, Sohail has done some hundreds and hundreds of these kind of interviews. He's done events all over the country in the last few months, physical. So he knows everyone, because he's the one who's inviting the speakers. He's the one who's having a great rapport and relationship with them. So you should be good to the organizers. Okay. I'm very clear on that front, because people forget this very, very basic courtesy.
Okay.
Number one. Number two is evaluation is a very, very different game. Okay. It is and until you get the term sheets signed, and even after that, till the money hits your account, you don't know what your evaluation is or whether it's working or not. Okay. So evaluation is a perspective from the investor, whoever is putting in the money, your ability to negotiate. How well are you able to portray that whatever you're doing is worth that, them to put in that $10 million? And you should also remember that if you're giving away too much of your equity for just 1-2 rounds, it's very difficult to understand this. Number one. Number two, Ellen, is have you ever raised any money before? They will look at anyone who's putting in money will also look at your funding history. They will look at your pedigree. They will look at your background. They will do due diligence. They will talk to your customers. They will talk to people that you've worked with. And only then will they come to this, safety parameters that yes, you're worth putting in money in. Okay. So I'm not sure, maybe you came in a little bit later, but we had spoken about that. All right, Elaine? Yeah. But be nice to the organizers, the most important thing. And learn how to use LinkedIn very, very, very well. Okay. Thank you and all the best.
Thank you. One last question. I have the speaker list. I have the organizers' contact, but I'm talking of the participants, the VCs that will definitely be available, because the event actually it's an in-person.
Then you announce it, Alan. I'll tell you what you do. Right? When you're going for an event or you're attending something, you let the world know that you're going to be there. And then you say, I'm looking forward to meeting VCs or founders or whatever. You put all that out, And maybe
Okay.
someone, if they see interest in you, look, it's also about the other way around, right? It's not just
Yeah.
about what you want. Would they want to talk to you? So how do you
Okay.
get a pull factor going in over there? So that's what you have
Thank,
to be focusing on.
thank you very much. That
You're
that that
welcome,
would
Alan.
thank you.
Thank you. So Shyam was asking that we are planning to start an IT consultancy service. Now, how we can start or what can be the process, how to get the clients on board, and how we can involve an investor in our company. An IT consulting service. Do you think an investor would be interested?
Service is very tough. And if look, what matters is start, right? Because why they will ask you, why do you want investment? What will be the, see, think about exit strategy. If they put in 100 rupees into your company, which is pre-revenue, you're not hired anyone, you're not got any clients yet, how will they get an exit after 3 years or 5 years? So I think that's, see, again, always think from the investor point of view, and then you will be able to crack things better. Okay.
So I guess one more thing is around scale. Okay, Vijetha. So basically, a lot of emphasis is usually on how fast can you scale versus how much revenue can you make or how much profits do you make. How and where does, where do these two different matrices get balanced from an investor perspective? Speed versus scale versus profitability.
So there are a lot of theories, right, Sohail? If you remember, blitzscaling was the biggest in fashion thing, and a lot of money was pumped into that. Now you also know what's happening with Netflix, right? They're losing subscribers, they're losing people, their evaluation has tumbled, stock prices has taken a thrashing of the century, right? So it's all very different on how it works. Facebook by itself, Meta itself, right? It's called as Meta. I think if you read the headlines, they grew, they were profitable, they had a tough time with their IPO, and then it went down, then they came up, and now again they're having a very, very rough time in the last few weeks. All tech companies are having a rough time. So Joyce, let's be careful here, right? Like scale, no, I will grow fast, but what if you don't have money to grow fast? What if you don't have the right team? And what if you are, onboarding customers without doing a proper due diligence, and you're not onboarding them in the right manner just to show numbers to your investor? They will start doing due diligence. They will start looking at the quality of your customers, of your data, of your metrics, etc., etc. And then it doesn't stand scrutiny, right? Then what will happen? You know the headlines that are happening around BHIVE and this and that and whatever it is, correct? So that's all I'm saying. Look at history. Read the headlines of just recently and maybe a year back, and then compare it to what's happening right now. So be very, very careful. It is not about just scaling up or speed or whatever. It is about will you survive. When you see, ultimately, the investor also, if you burn too much and you just get rubbish customers who are not really going to contribute or pay or are not the right type, then every other metric fails except for the quantity. Right, your retention is gone. People are asking about retention, month-on-month growth, and all those kind of stuff. Right? Are they actually paying you? Is your unit economics good? Do you have enough runway? Do you have the right team? Are you not getting into unnecessary controversies and harassing customers or whatever it is, right? So there's so many metrics which will come out, and Glassdoor interviews are there. Here people will start checking the quality of your company. They will talk to customers. They will talk to the partners that you're working with. So be careful. One has to be very, very. There's no right or wrong answer. So it's about being, doing the right thing at the right time. For example, when you know that you have cash in the bank, you're getting good customers, your unit economics are good, then you should rapidly expand. But if you know that, you have to be careful, the market trends are different, market conditions in your industry sector are not good, and it would be smarter to conserve money and grow in the smart way without burning yourself up, etc., etc. So at different times, different thought processes and strategies have to be adopted. And the skill set is knowing which one to adopt and reading the market conditions and knowing your team and your customers, your partners really well. I think that's what really matters.
So one last question. I want to talk about competition. Okay,
Okay.
so this is something which a lot of people don't talk about, and this is something which I am also very interested in. Understanding how, is there competition in the VC ecosystem or is it a collaborative effort? So if let's say investor A puts in money in a company, investor B should ideally also put in money if the company is good. right? Versus, if there is an investor who's put in money in company A, company B will try and put money in the competitor and try and grow the service. So I want to understand, how does the whole competition aspect work in the VC ecosystem, or is it just completely collaborative in all manner?
See, everyone wants to put in their money in the best startups and they want to get some great exits. That's what happens everywhere. And also remember that even founders want to have the finest, people to back them up, not just with the money, but because they know that many of the larger VCs who have international presence and a large team can open a lot of doors for them and can give them a lot of, positive learnings, reaffirmations. They can interact with the pool of, whatever the massive ecosystems that these VCs have, and also the other founders. Okay. So if you see the, again, metrics, right, go back, who are the biggest investors, the top 10, 15 investors in India in the last 5-10 years, you'll get to know that, right? So you, again, you break it up, it's early stage, seed stage, angel investing networks like Indian Angel Network, Mumbai Angels, we ourselves at Dexter Angels. So everything, you look at that angle of it. It's not about competing, but everyone wants the best. Everyone wants the best of term sheets. They want the best of, the founders and investors in their portfolio. And it also depends on the stage. For example, if you're an early stage VC, you'll not be able to get, and unless you have backed up the founders when they were raising early stage, you can't really touch Series C, Series D kind of founder because it doesn't work for you, right? And then someone who does only Series A and above will not look at early stage, right? They will look at someone who can already has proven, has raised some money, has got some great folks on their cap table, is growing, and then they're ready for the large tickets. It all depends on the founder and investor matchmaking. I would not say it's about competition because there's plenty of opportunities for everyone. And also many of the VCs have got their own portfolio to take care of. So it all depends on what stage they're in. It all depends on market conditions. So there are many, many elements, Sohail. I mean, I hope I've been able to give touch base upon at least a few of them. But it's not about competition. It's not about fear of losing out or missing out or whatever. It's at what stage are you at, and how well are you being able to negotiate, get the best for investors to come into your startup, and vice versa. Can the founders decide, okay, these are the 3-4 investors that we would love to have on our cap table, and they start interacting with them pretty early and convince their people that we are the finest folks and we can really grow and we are serious about what we're doing. We understand the market conditions very well. We have the team to crack it. We get the competitive landscape also, but we can, definitely go ahead. So it's a lot of conversations, a lot of thought processes. Yeah, that's what it's all about. So
No, so I basically, so it's like, companies compete, but investors usually collaborate.
yeah,
Is
because
what I
see, everyone,
understand.
see, lead investors, right? Lead investors put in say 50%, but the balance 50%, they need 3-4 other people to come in. Right. So it's not about, it's definitely not about, because everyone has to work together. Yeah? Everyone
So,
works together.
so if there are 50 investors together in one room and there is one company, then there are chances that all of these companies might. So a company will not, sorry, an investor will not try to block another investor, is what I understand. That thing doesn't happen.
No,
It's
not really, not
completely
really.
on the investor.
See,
Okay.
it is ultimately the founder has to sign the term sheet and agree, no? And again, they do their due diligence, as simple as that. If you don't do your due diligence, if you're not comfortable, and if you look, you have to work with your investor, right? Because ultimately the investor will make his or her money after they get an exit. So they are going to be batting for you, and they're going to be talking to the next, the much larger VCs to make sure that the exit happens, because that's when you make money, they make money. It's simple.
Got it.
About founder chemistry, so I will just touch upon that. So yeah, because it's a team that makes things happen, no? So it's not just about founder chemistry. It's not that even if things are going wrong, they're saying, oh, we are getting along very well with each other. Even if one founder is doing not very smart things, the other founder says, oh, we have great chemistry, we don't argue, we let things go. And no, I mean, what is the meaning of founder chemistry? Right? So you have to be very cautious about that. Founder chemistry is also about having the skill sets to handle situation, to stay as a team, like everyone has their own strengths, weaknesses, complementary skill sets, etc., etc. So that founder chemistry is that making things happen for the organization, which is right, which is ethical, You're taking care of all the stakeholders, right? Your stakeholders, your other partners, your team, your other co-founders, your investors, and the people that you're working with in the community and ecosystem. So that's what the real task of a founder is. You can't ignore anything. You have to wear multiple hats in a day of different things. One day sales, one day marketing, one day hiring, one day whatever it is, right? So it's not an easy world. It's not a tough. It's very tough. But founders who have each other's back in the right ethical manner is what is really meaning of founder chemistry.
I think it has nothing to do with investors. I think for your company's survival, I think co-founder chemistry is important. Without a co-founder chemistry, I don't think a company can actually grow.
True.
So it's
Very
as
true.
simple as that, yeah.
Correct.
Cool. Anybody else? I think we have covered kind of everything. We've touched upon all aspects, Vijetha sir. And this went by so fast. And this is an amazing discussion here, Vijetha sir.
Yeah, no problem,
Usually,
sir.
it's been an amazing time chatting with you, Vijetha sir. How was your experience?
Amazing, sir. Thank you so much. I will talk about what Akhil, if Akhil, I'm not sure if he's there, but he's asked this question about, we did talk about it, the due diligence that is being done by angels in a pre-seed round. See, they will look at the founding team very closely. There'll be a lot of thought process around corporate governance, due diligence, like what exactly are you doing? I mean, is your technology or whatever, the marketing strategy, the team that you're building, that they look at all these things, right? And they'll give you milestones. I just want to articulate and explain that again, right? There will be milestones. The money will not come in one single shot. It will come in tranches depending on how many milestones and the metrics that you're achieving. Okay. So supposing you say I'm not done the MVP yet, but I need X amount of money. That's okay. We'll give you this much. But you have to achieve these milestones. If you don't achieve these milestones, then you'll not get a next tranche. And then there are so many other term sheet clauses that will be there. So it's also about that. Like, what will you really do?
I think term sheets in itself is a chapter in itself.
Yeah. It's a
There are
huge thing.
Yeah, a lot of people don't understand the whole idea of term sheets, but it's actually a legal document where a lot of things might actually be hidden, and every term sheet is different. And
Yes.
you
Shareholder
have
agreement, the term sheet, all these things are very critical elements that a founder doesn't pay attention to. And you can't give excuses. Yeah, I just want to stress on this. No, you can't say I'm first time. I didn't realize. No, it doesn't work that way.
I think as a founder, I think my biggest learning was that 80% of your time will go with legal and accounting. You really can't do
Very true.
anything
Very true.
about
It's very
it.
tough. Yeah? Very tough.
Yeah.
But absolutely right, Sohail.
You basically start thinking that I'll build this amazing product, and then eventually the product is being built by somebody else, and you are sitting with the legal team and breaking your head with the clause which you
Correct.
don't
So you have to wear
understand what it
different
is.
hats, and in a day you have to maybe wear 12 hats. No, in a 14, 15-hour day.
Yeah,
As simple as that.
Absolutely. Got all of you guys for joining in. This has been an amazing discussion, Vijetha sir. And all the very best with Dexter Capital. Hopefully, a few of the companies from the Builders Club also land up on your portfolio. Touch wood. Soon. And with that, we'll just call it a day. Good night, everybody, and have a great weekend.